Welcome, everyone. Today we're sitting here with Gary Shields, who's our chairman and managing partner. Gary brings with him decades of experience across investment banking, venture capital, and a multitude of situations and deals. And he's going to be sharing some of those remarkable insights with us here today.
Yes, we're very excited, Gary, to dive deep into your background and share some wisdom that will be of value to our clients and partners. So excited to get into things.
Gary, could you walk us through some of the earlier stages of your career that really set the foundation for your later success?
Sure. Going back to going to grad school at Georgetown University, the Foreign Service School, I got introduced to international finance there, and maybe more in a broader sense, finance in general, and the importance of finance to the corporate world. I had the privilege during my graduate years to work for Superior Oil Company, which ultimately was acquired by Mobil Oil, and we were trading agricultural technology for oil rights in the Middle East, which was very interesting. That was in Washington, D.C. I worked for a summer as well for the International Trade Commission, so I got a good sense of the government workings, that kind of thing. I started my career in traditional banking with the largest bank in Houston, First City National Bank, and worked with Asian companies there, large Asian, the trading companies, banks, et cetera, and got deeper involved in the whole world of accounting and finance and how important those things are to large companies. From First City, I was recruited by Credit Lyonnais when we were opening the Credit Lyonnais office in Houston. So I was the first non-French person in the Houston office, along with a French partner or colleague. We opened that office, did extremely well. We penetrated the market very well. We were one of the leading international banks or finance companies in the region. One of the transactions that we were involved in was for a large oil company, one of the largest oil companies in the world, that made a $1 billion acquisition. It was Shell Oil Company. We, along with two other large European institutions, provided $1 billion in financing to them. So we were actively put that together. From there, I moved to Chicago with Credit Lyonnais, where I was scheduled to be named the head of the Chicago branch, about 65 people. Again, getting more and more involved in finance, and in that case, it was financing Fortune 500 companies, technology, all of the auto companies, the oil companies, electronics companies, healthcare and medical companies, but all Fortune 500 companies, providing billions of dollars of financing for them, doing traditional lines of credit loans. We did an accounts receivable purchase from Sears along the way, and I became more active and was also at the same time learning more and more about equity trading, and I became personally interested in stocks and options and futures and that kind of thing. My name was known by some folks in New York, and along the way was recruited to move to a firm named Technological Investors in New York, and that brought me to Wall Street. That brought me to New York. That firm was a pioneer in technology investing. We invested in early stage companies and emerging companies. We also ran two long-short hedge funds. So that got me deeply involved in investing and in the investment banking world. I was working with the large investment banks, banks where, for example, Juan had experience, and other folks, the leading investment banks looking at investing. We invested in some private companies as well. Along the way, then I joined, I was getting to be known in the technology world, and some of the local media and national media picked up on some of the work I was doing and some of the investment banks did. And I ultimately was recruited by LF Rothschild, one of the leading firms in funding emerging companies. So I was a senior research analyst there, covering originally storage and the storage industry, and then ultimately semiconductors and communications. That firm did extremely well. It was one of the most powerful firms, as I say, funding emerging companies. So it allowed me to dive deeper and deeper into the industry. I picked up my Chartered Financial Analyst designation along the way, CFA, and that helped me refine more my approach. And I realized along the way that at the core of everything that I was doing was what I would call research, meaning getting to know a company deeply, and not just doing a transaction or having a one-time relationship, but getting to know a company, what its true needs were, that type of thing. I then was recruited away from LF Rothschild by Robertson Stephens, and was actually known as Robertson, Coleman, and Stephens at the time. Then Bob Coleman left, and it became Robertson Stephens. Initially was a research analyst with them and working on some IPOs and other financings. Ultimately then transitioned to the investment banking side of the house. That was a fun organization to be with. We were, I would say, probably one of the smallest, if not the smallest, of what we called the major bracket firms underwriting technology and medical, emerging companies. We were known as one of the four horsemen of Wall Street, underwriting the IPOs, secondaries, that type of thing. From there, I actually went for 1 year to head up the technology and healthcare investment banking groups at the Chicago Corporation. Decided that actually Robertson Stephens had brought me to San Francisco. Really personally enjoyed California, so while I was at Chicago Corporation, I got recruited away by a young company, emerging company named Integrated Medical Systems. I became the #2 guy there. I wrote a check to invest in it, but also became, as I say, was the #2 guy, the senior vice president, corporate finance and development. And we grew that company over the ensuing years. I put together a strategic alliance with McKesson Corporation, and then it was clear that the investment community and institutional investors wanted us to go public. So we decided to go do our public offering, and in the midst of that, we were contacted by Eli Lilly, and I ended up negotiating an all-cash sale to Eli Lilly of that company, and we made a really nice return for investors. So those are sort of the early leading up to my going independent, if you will. At that point, when we sold the company to Lilly, that had brought me to San Diego. I was fortunate to be able to decide if I wanted to go back to New York. Integrated Medical Systems brought me to San Diego, and after we sold the company, my wife and I decided we wanted to stay in San Diego. And so I jokingly tell folks I opened the yellow pages to investment banks, and there were none. So I had to form one. So I founded an investment bank. We became very active in Southern California investment banking activities. I had two partners. We did hundreds of millions of dollars of early stage financing, representing early stage companies, doing M&A work for companies. I'll share just maybe a couple of interesting stories. I helped one company that couldn't decide what to do among the board. Some wanted to invest in it more, others wanted out. They weren't quite sure what to do, so they hired me to recommend to them what they should do to solve this issue of having board members with different interests. And I determined that they could go public, do an IPO. They were surprised that we could do that. I then traveled around the country selecting the underwriters to do the public offering, given my background in being very involved in IPOs and secondaries, whatnot. Another example is a software company that I represented that was, we initially went out to sell the company, 100% of it. And we were willing to sell the company, if I recall, it would have been probably about $25 million transaction. Along the way, the company was contacted by a venture capital firm, just asking for general interest. I know the firm, it was typical that they would reach out to emerging companies and say, could you send me a little information so they could put it on their radar. We were having a problem selling it, but when they reached out, I recognized that firm and I knew their arch rival competitor. So I called the arch rival competitor and I said, you need to come see this company because your competitor is interested. So they wanted to come out, and that was on a Friday. They wanted to come out over the weekend, so we couldn't accommodate that. They came out on the following Monday, and the two firms then started competing. They started at about $30 million, as I recall, in valuation for the company. It's kind of this is like a wonderful story for the entrepreneur. They ultimately drove it up to a $300 million valuation. And the founder said, Gary, time out. Let's do a transaction. So we ended up doing a transaction for $30 million, selling only 10% of the company. So that was a big, big deal. And it was one of the most well-known transactions in the San Diego area at the time. Along the way, in doing my investment banking work, I met up with Ted Waite, the founder of Gateway Computers, and Ted wanted me to tell him whether he should invest in additional money in a company, and he had put certain millions of dollars in the company and wanted to know if he should put more. And I spent about a month with the company examining it, again using that heavy-duty research background that I had, and I concluded that I wouldn't put another penny in the company. And Ted said, well, I really like the way you think, because it was his cousin's company, and the assumption was anybody getting involved would probably tell him to put more money in, since there was cousin. We didn't put more money into that, but he had a bigger opportunity, which is he had several investments in companies, private companies that he'd made, a variety of companies, none of them really connected or under one roof. He also was a large limited investor in a large venture capital fund. So he made the offer to me to move all of that to San Diego, run all of it. And ultimately, then we formed two other funds following that. Through that, I sat on 20 venture-backed boards of directors, invested in more than 50 companies, had a really good return in the funds. And then along the way, transitioned back into investment banking. I ran a few companies as chairman, CEO. I had a couple of moderate successes, a couple of not so moderate successes. And along the way, more recently, as I was doing investment banking, I was contacted by Juan and Saul and a couple of the partners at Nassau Street Partners, inviting me to be a senior advisor to the firm. And it was originally intended that I would just give them my advice in terms of building the firm, that type of thing. That quickly expanded into initially filling my schedule about a quarter of the time, and then a half and three quarters, and ultimately about 60 hours a week, and working with the firm. And about 3 weeks ago, maybe a month ago, I don't remember exactly the timing, they made an offer to me to be the chairman and managing partner. I'm very, very proud of doing that. I really like Nassau Street Partners. They are the fastest growing firm that I've ever experienced. Extremely knowledgeable, very, very good at completing deals. And I just want to thank Juan and Saul for inviting me to share this journey with them.
Jerry, thanks for the value so far. I'd love if we could get into a bit more detail on that transaction that initially started at a $30 million valuation of it and escalated to the $300 million total. Could you speak on that a little bit?
Sure. So I got involved in that transaction. One of the leading attorneys in San Diego referred me to the founder who had built a very successful software company. They were doing well. They were EBITDA positive, had pretty good revenue, growing very rapidly. And we went to market with that, as I said, trying to sell it. And we were having a problem getting traction. And I think it was, I couldn't really quite figure out what the reason was for that. But we got interest from some parties, but it just wasn't leading to the sale of the company. So along the way, the company was approached by a large venture/PE firm that simply was gathering information. And in the investment community, it's not unusual for VC firms or PE firms, whatever, to gather information. They have young people who call and say, send us your brochure or whatever. So they wanted to know about that. At that point, I realized that particular firm had a strong competitor. That firm was on the East Coast, had a strong competitor on the West Cost, thought might have an interest if I could convince them that the East Coast firm had an interest in it. So to create what I would call a dynamic competitive situation, I called the West Coast firm, told them that the East Coast firm was very interested in this company. The West Coast firm immediately became interested, wanted to come to visit the company the following day, which would have been a Saturday. And the company said, they didn't work weekends. So on Monday, the West Coast firm showed up, and it was very clear they were extremely interested in getting the business of investing or buying this company. It was sort of open as to what they wanted to do. So I asked them to make an offer. So they made an offer to invest in the company. They started out we were right around $30 million in valuation. The East Coast company found out the West Coast company was interested, so the bidding started. And the bidding work went on and on and on. They just kept increasing. And it was clear that either firm would take the entire transaction. And they bid it up to a valuation of $300 million. And they were firms that invested in companies where the founder could take a certain amount out off the table, and they would also put additional growth capital into the company. So that led to, as I say, this dynamic competitive environment where we like to say actually at Nassau Street Partners that one of our principles is to get two interested parties in a company, in our client, because that creates a real bidding situation. So in that situation we got the bid up to $300 million, and at that point the founder came to me and said, this is enough. Before they decide to go away, let's take the money. So I said, well, okay, we're not going to choose one or the other. I went to each of them and I said, here's the deal. Rather than one of you putting $30 million in, we're going to give $15 million to one, $15 million to the other, because I also told the company that he should recognize that he gets two for the price of one, essentially. And that if one firm turns against him, he'll have maybe a potential friend in the other firm. And that, it was really the best thing for the founder. So we ended up closing that transaction in, I don't remember if it was 3 or 4 months. After we closed it, there was an attempt to do an IPO, or plans to do an IPO. I don't remember the specifics, but they tried to do an IPO. They had to hold off doing that because of market conditions. They ultimately sold it to another company which then sold it to one of the giants in the industry for $1 billion. And the founder made a lot of money out of it. So that was kind of one of the interesting transactions that I worked on. Very, very satisfying. Through all of that as well, the founder and I became very, very good friends and have been ever since.
I'm glad you mentioned that, Gary. I mean, it's often, in my opinion, when we see that deals reach closure the fastest, that we maximize terms, there's more than one party.
Yeah.
And, if there's only one, the investor can feel it, and they know. And that's when they drag on. Deals drag on. There's endless chasing.
Yes.
And, what I found through working with you is that your ability to create that extra level of interest, whether it's by complementing it with a family office, with a strategic, with a high net worth that can come into the mix, frankly, is what plays a critical role often in getting deals across the line.
That's absolutely true. And I'm glad you mentioned family offices, because when I was working with Ted Waite and running all of his private equity investing, private company investing, I should say, when we would step into the mix, he was well enough. No, he was a celebrity in technology, and when we would step in, it really added a big stamp of approval to the company. And that we were able to draw in additional investors by our stepping in and agreeing to invest. So, and you could sort of feel that. So I think you're absolutely right with regard to family offices, that depending on the particular family office, they can bring an element of dynamism to the process.
Certainly, and it's quite particular with family offices that oftentimes they do like to syndicate, and if you bring one,
right,
it's almost this tell your friends effect. And some of them are structured that way with a multifamily office, but some of them, getting the stamp of approval of one, whether or not it's an anchor, frankly, then leads to many more, and it's finding that initial one. All right, and once you get over that hurdle, things become far more streamlined.
Yeah, I think that's true with every transaction, and whether it's a family office or a venture capital fund or whatever, getting that first person or first entity in is very important. Interestingly, I was talking with a family office a few days ago, and the guy running the family office said that family had founded a very well-known technology product that was a consumer used product, but sold millions and millions and millions of copies of that, and made a lot of money and formed the family office. He told me that they were working on a deal about a month ago, a $40 million deal, and they were going to put in, I think, 5 or 10 million, I don't remember, but he said within like a week they had closed out the transaction with their friends who were. Yep. So your point is very well taken. It's a trust issue, I think, that if you pull in one entity that's highly regarded and trusted within the investment community, right, others will come in.
Well, that I think speaks to why we have a process that's so rigorous internally in terms of due diligence and vetting. Our VPs, and Sol can speak to that, go through a process whereby they have to run possible engagements through our bankers, through our investor relations team, ultimately through me and you. And frankly, that's part of that vetting is because family offices are going to do it anyway, and we need to make sure that, number one, we're comfortable in the engagements we're representing before these groups, and ultimately that we're confident in the health and the long-term prospects of the companies we represent.
And I sometimes summarize that as saying that there are two names on that transaction that matter to me: the client's name and our firm's name, right? And our reputation is really determined by our ability to make the right decisions, choose the right clients,
yes,
and understand where we might take those clients. In joining Nassau Street Partners, one of the reasons that I became involved and have continued to get more and more involved is the respect that I have and the fact that I've been impressed with the way that Nassau Street Partners has been able to come up with develop meetings and deliver investors to the client side. It's actually very impressive, far more than most investment banks that I've ever seen. So,
well, it's one of the advantages, I think, of the boutique structure that, our team, when we take on an engagement, it's not siloed somewhere in the bank. It's very much a team-wide effort. Our entire team knows about it. We've been briefed oftentimes a long time in advance, and we're anticipating the engagement coming in, and we're already thinking and we're already putting in additional diligence as to positioning, as to who we're going to bring it to. And so when the whole team can get behind a company, that's why you see outsized results, right? I come from a world where everything's massive and things get lost, and it's hard to retain focus because there's 1,000 things happening at once. And so I think that's one of the great advantages we have as a boutique over larger players. I always say, size does not dictate quality at all in that respect.
No, it just brings to mind that with a lot of the traditional investment banks, mainly I'm talking the boutiques, they'll touch one person. Saul might attract that client, and Saul will be the only person they ever see within the firm or hear from. The Nassau Street Partners' ability to attract the client, and then when I'm involved in calls with Saul or some of the folks who report to Saul, I'll tell those folks that Saul will be the first person that they meet, but they're going to have 4 or 5 other touch points before their deal even goes to market. And all of those people are very carefully chosen, and they're real pros in what they do.
Yeah.